let's take a look at the bigger picture. Matthew Johnson's with us, president owner, Johnson Wealth and Income Management. Thank you for being here. As a matter of fact, someone called me first thing this morning saying, are we going to have Black Monday? And thankfully, the answer is no. However, some of these banks are having a very difficult time today, to say the least. What are your thoughts here?
Well, thanks for having me back on. It's a pleasure to be here. It is absolutely a dichotomy. When we think about everything that has taken place over the course of the last 2 years in our country, where we shut the economy down, we send everybody home, and then we realize that the economic car is on the side of the road and we've got to get that car moving again. We go right into quantitative easing, right? We slam interest rates down to zero. We take and we stimulate the economy. We stimulate households with cash, and we say, okay, go spend because we need to keep the car moving. And what we see is the implication there. If you keep doing that, you're going to see an economy that swells, and before you know it, the car is careening out of control. And so all of a sudden, there's all of this deposit that's starting to pound into the banks because they're borrowing money, and the banks are swelling. And all of a sudden, we have this reversal of the interest rates. You know, I hate to say it, but I'm not here to be a negative Nancy, but I'm here to be absolutely honest with my clients. As their fiduciary, we have to understand the implications of the Federal Reserve raising interest rates. They're going to continue to contract the economy. This is going to continue to have an impact on the financial markets and especially the banks. Now, what's interesting about SVB, and one of the things that I've suggested to my clients is, you know, when you look at how they were investing their money, they were very niche. They were extremely focused on the small upstart that was coming online. In fact, that's where the majority of their business laid, 29%, I believe it was. And this is the reason why diversification is so very important. And it's not just a diversification for us as investors, it's diversification for the companies and the corporations that we're investing in. Now, I'd like to think that this is an isolated incident. I think that it is. But I think in many respects, it's going to cause a lot of banks to be under the scrutiny and under the watchful eye of so many different institutions, so many investors. And I believe that there's going to be some dirt that was swept under the rug that we're going to start to see. That's the reason why we started with one bank, but now we're up to, what, 4? And I think it's going to progress a little while longer. What I'm hoping is that Americans don't do a knee-jerk reaction where all of a sudden they start to do a run on their local bank, because that can have some very systemic effects. This is something that I believe is very isolated, but we have to be very careful of it.
Yeah, without a doubt. And that was one of the concerns and one of the reasons why regulators did step in and basically provided a backstop for SVB, because they saw that that was about to happen. I mean, there is no doubt that everybody was about to be lined up at their regional banks with so much concern there. However, my concern here is that, do we see another failure? Are we done here?
Well, I don't think that we're necessarily done. I think that if you put these banks under scrutiny, you're going to find probably a few more that have had some really tough times. And let's face it, when the feds raise interest rates, they break stuff, right? That's just the way that it works. That's the result of interest rates going up. I don't think that we're going to find banks that are quite to the effect of SVB. I believe that there's still probably going to be some things that banks need to tighten up. They need to have some responsibility and look at the diversity of what their actual customers are, and making certain that they're stable and they're solid. But I do believe that there's probably going to be a few more that come out by the end of the day.
By the end of the day? That's
by the end of the day, meaning by the end of this whole crisis that we're seeing right now.
By the end of the episode that is happening.
That's correct.
I was like, by the end of the day today, I see what you mean. By this what's going on here today, because I was going to say, well, we've had 3 that have been halted all day long. That being said, tell me about opportunity, because there are some banks that are going out, baby out with the bathwater, and some of these financials are pretty great. Now, we know that the Fed was well aware that raising rates at the trajectory that they were doing so. In fact, it was in the minutes saying, are we providing for financial stability? There was concerns about raising too much too fast, et cetera. So they knew that this probably something like this could occur. That being said, now, what do you tell investors? Would you get in there and start buying bank indexes? Would you buy money center banks? Like, would you buy anything in this group?
Well, the first thing is that let's talk about the rate increase, right? We're going to be seeing either a rate increase or we're going to see no rate increase whatsoever. Now, I know what the market is expecting, and I know what the banking industry right now would like the Feds to do, and that is absolutely no rate increase. And yet, at the same time, I would hate to be in Jerome Powell's footsteps, because he's in a position where, if you look at the data that came out after the rate increase in February, you notice that it's egg on their face, right? The inflation needle didn't move. The PPI index was up, retail was up, all sorts of things were up. So the economy is still technically strong, but that's the reason I say that this is an isolated incident. That being said, I don't know that I would jump into the financial sector, the bank sector right now. I think you got to wait for some things to shake out and figure out what's actually going to be found as investigations are done and people are starting to become more transparent with the numbers, what's happening within their own bank. That being said, this is the reason why we go back and we talk about diversification, right? You don't want to have too much of your money in any one particular sector. So what we do as investors for retirement is extremely important. We don't want to be carried away by one sector increasing, another sector going up, and being caught up in that optimism. We want to stay very fundamental, making certain we've got good quality cash flowing companies that we own stock in that pay dividends. We want to take a look at fixed income. I've been saying this for 14 months now. Fixed income is on sale, baby. And we need to be loading up on good quality fixed income because it's contractual income. You're growing your money the old-fashioned way through income being produced. And what that does is that helps you to be able to dollar cost average when you get things like this. If you'd like to nibble, go right ahead. But focus on the bigger banks right now. I think that they're going to be the safer bet.
Yeah, and as you mentioned, the Fed, whether or not they will or won't raise March 22nd, I mean, obviously 50 basis points is now off the table. 25 basis points is becoming less and less likely. Jan Hatzius over at Goldman Sachs, who had originally said 4 hikes, 25 each, now says nothing on this next meeting. And now there's even on the curve, it's back, the cuts, the rate cuts at the end. What do you foresee the Fed doing, and what would you say they should do?
Okay. Well, the last time that I was on this program, it was it 25? Is it going to be 50? And I said, listen, the data suggests that if they want to keep this momentum, they're going to have to do 50. Well, they turned me into a liar and they did 25. But then all the data came out that said, no, they should have done 50. In light of this information and what has happened with this terrible failure, the second largest bank failure in the United States in history, I think that there is a tremendous amount of pressure on the Feds not to raise interest rates. That being said, they also know that the bank, that's just one tiny sector. And so they may end up still forging ahead with the 25 basis rate increase. I think that it's a possibility. However, rate cuts, put it out of your mind. I don't think that that's going to happen right now. I think that they're going to say, listen, the reason that the bank got into trouble is because they weren't diversified enough. They were too niche. They focused on too much of a high-risk sector. And that sector has been absolutely just beaten down with the rate increases. So I think that they're going to say, we still have a job to do, and we can't let this persuade us away from doing anything other than our job. That's what I think we can expect.
Right. Matthew Johnson, good to see you. Glad you were able to be with us today. Matthew Johnson, President and Owner, Johnson Wealth and Income Management.